Yo, what's up, everybody? Friday, March 25th. Not a bad close in the market today, given the interest rate situation. We saw 10-year yields really shoot up. I saw a lot of commentary on Twitter, people freaking out. It's like, oh my God, it's a crash of the bond market. 2.5%. Oh my God, it's horrible. So stocks pretty much up. NASDAQ just down slightly. Folks, this is going to be a real test of the stock market's resilience in the face of, not just in the face of rising interest rates, but in the face of the, I guess, widespread belief that rising rates are negative for the market. I mean, at some level, yes, I understand that they are. Stock market is down from its all-time highs. A lot of this has already been baked in and discounted in. But we're talking about 2.5% interest rates, maybe 3% interest rates. And again, going back to what I was talking about yesterday, in terms of what is the Fed's ability, not so much the ability, but when the Fed has to pay interest on reserves and interest on what's held in the reverse repo facility. I saw something today, I think it was some Citibank economist or something, saying like they're predicting a 3.5% Fed funds rate. That's a 200 billion liability for the Fed. A 3.5% Fed funds rate, when you look at reserves in the system and what's in the reverse repo facility, 6 trillion, that's a 200 billion liability for the Fed. The Fed made 111 billion last year, so that's a negative cash flow of almost $100 billion. Maybe not that much, because the Fed's earnings will go up as interest rates go up too, based on their holdings. But it's going to be a very interesting situation. But I'm not going to get back on that point again today, because I talked about that a lot yesterday. I just want you to understand that we may be in, not me, but I mean, many of you may be in for a major, major educational experience on this whole rate hike, hysteria. This is classic MMT, folks. I mean, rising rates, two things. As I've said so many times here on this channel, it's price setting and it is a fiscal expansion, because the government is a net payer of interest, so interest payments are going to go up. So that interest channel is going to be funneling more income into the economy. And you could see this very clearly in past instances of rate hikes. If you look at interest income as part of personal income, that goes up, and vice versa. In periods of rate cuts, dramatic rate cuts, you see interest income flows go down. So, and it should be completely understandable. I mean, that is a form of fiscal flow. It's not in any way, in my mind, fair, because it goes to people who have already means. It goes largely also to financial institutions that have means or the ability to tap into capital markets. It doesn't go to the average person. And that is a matter of policy, all right? But we'll see what's going to happen. I mean, look, last month when the Fed raised rates, actually it was this month, what am I talking about, March 16th, when the Fed raised rates, and I spoke about this, there was so much confusion, not even confusion, just I would say like incredulousness on the part of the financial community. I talked about watching a clip from CNBC where the chief economics correspondent, Steve Leisman, he's like, I can't figure this out. Why is the market going up? And if you understand that, number one, this move was entirely baked into prices. I mean, we've been talking about this, not we, but I mean the market has been anticipating rate hikes now for a long time. If you go to that FedWatch tool at the CME, you see now the 50 basis point rate hikes are priced in for May. They're priced in for June. July it's still at 25, but we'll see what happens. But I mean, if you are a trader, if you understand market psychology, the market tends to discount a lot of these policy moves, and they're already priced in before they even happen. So that was one thing. The other thing is, like, it doesn't even reflect the fiscal aspect of this. And that's something they're just never going to get. I'm sorry, because these people are operating in a I said it before, in a kind of mythology, in a paradigm that's all their own, that's not applicable to reality. And so they're going to see that through the prism of their own beliefs. And when their beliefs say, this is just like, it's just axiomatic that when rates go up, stocks go down. In their mind, it's an axiom. Right? It's something unchallengeable. It's just like, it's a law, in a sense. And it's not. I mean, if anything, it's subject to interpretation, but even more so, I think they have the understanding backward. I think they have the understanding backward. I've been a long time, what can I say, researcher of this. I've been a long time a student of this. I've looked at it. I've been a trader for so many years. And then through my understanding of MMT, I've applied this understanding. It doesn't mean like it happens on the instant, but it does mean that there are predictable consequences from this. And it is opposite from the mainstream view. But we'll see. I think we are lucky in the sense that we're facing kind of like a real-time laboratory. We're going to be able to see the results of this. But just let me throw this out there for you. If we get a 50 basis point rate hike in May, which we're going to get, I mean, there's no question that now this Fed, the Powell Fed, I mean, they are the most slavish to the market of any Fed that I have ever seen, by far. I mean, I've kind of wavered back and forth on my estimation of Powell, but I think now, there's no more, it's not up for debate anymore. I think this guy, he is the most slavish. This is the most slavish Fed to the market that we have ever seen. In other words, the Fed is just going to do whatever the market says. This is not the behavior of a monopolist, right? That would be like John D. Rockefeller polling or surveying all of his little, all his little competitors and asking them, hey, well, what price should I price my oil at? No, he crushed them. He did what he wanted to. The Fed is a monopolist, and we have a bunch of people here running the Fed who are completely like clueless to that understanding. I don't even know how else to say it. That's just the bare truth. They're clueless to that understanding. So like, I happen to think that, Powell initially, that we got to go back a year ago to March 2021, that, they were right in their assessment that inflation was transitory. But you might say, Mike, come on, it's been a year now. It's not transitory. Well, okay, we've been hit, the whole entire world has been hit with these like unprecedented sanctions against Russia. And I've been down the line. Russia, 30% of the world's energy supply. No, 11% of the world's energy supply. Well, combined, if you look at crude and natural gas, it's like 30% of the world's energy supply in petroleum anyway, and natural gas. And wheat, 11% of the world's wheat supply. If you combine Russia and Ukraine, I mean, you're talking about massive, massive dislocation in raw materials and we're talking about food, we're talking about energy. This is not, I mean, these are basic things. And Biden came out and said, okay, we're going to have big time, food shortages, but that's the price we got to pay. That's his war, folks. That's his war in Ukraine. And he's saying, you got to pay for my war. You got to pay for my war. Not me. I'm doing it. I'm declaring it. We're on the right side, but you got to pay for it. Well, I don't agree with that. So that's where we are right now. We got the sanctions. If it were not for the sanctions, we would have already seen a moderation in a lot of these prices. I mean, we were already starting to see a moderation in these prices. But these sanctions now, and they are permanent. I mean, we might as well understand that these things are permanent. Yeah, they might be lifted in 20 years. I don't know. Putin's not there anymore. If Russia acquiesces to Western demands to become like a Western-style, open, neoliberal kind of state, maybe eventually. It's all about money. Like if big Western corporations can make big money there and Putin's gone, that's the key. But, we're talking way down. These sanctions right now are permanent, which means they're going to elevate the price level. It's a permanent elevation in the price level. And from that permanent elevation in the price level, depending on, near-term conditions, short-term, medium-term conditions, like it can go anywhere. Like I saw one very savvy oil trader who's talking about $250 a barrel. Now I don't think it's going to go that high, but I don't know. But I do not think that the U.S. economy is going to be impacted to the degree of going into a recession. And I said this in prior videos. I don't think we're going to be impacted in the magnitude of actually being in a recession unless we got to go well above $150 a barrel. And again, I said this is not 1970 where we are a massive net importer, and that is a key factor. We are a net exporter, which means that exports will add to final sales of domestic product, and that is part of GDP. So that is an offset to inflation. Almost 1 million barrels a day net exporter. So there you go. But the main thing I am interested in, I can't wait for that May Fed meeting. I think it's going to be really, really instructive. Who knows? Bond yields could keep going higher all the way into that meeting. We're a month away, more than a month away. What am I talking about? So there's plenty of time. But let's watch the stock market. Today I think it was a very good outcome. Stocks are strong in the face of a big rise in 10-year in yields, and everybody was freaking out about that. I mean, the people I follow on Twitter all day long, it's like, oh my God, look what's going on. Stocks just shrugged it off. And that's a good sign. And it's in line with what my thinking is on this. So for now, I'm staying bullish. We got right now a 550 billion month of March. We still have 5 statement days to be reported in the daily treasury statement. That's another 125 billion. So we're going to be around 650 billion for the month of March. That is a very strong fiscal flow. It's really, really hard to get bearish on the economy with 650 billion. Now, that's not going to be the case in April. But I mean, February, 609 billion. March, 650 billion. Those are good flows. Very good flows. And you got like California now with a 31 billion budget surplus, talking about sending out $400 for each car in a household. So if you have 2 cars, you're going to get $800. California is dispersing some of its fiscal. That's a huge economy. It's the 5th largest economy in the world. Other states have been suspending the state gas tax, so fiscal. Plus, you have in Europe, Germany, a lot of these European states now expanding their fiscal because of the war. All very positive. All very positive. Anyway, it's Friday. Enjoy, everybody. See you tomorrow. Bye-bye.